Hello and welcome back to Dukascopy TV. Let's just take a quick look at the Bank of Canada interest rate decision today. Analysts expected no change from the board, and that's exactly what they got. Well, on the line from Toronto, Canada, is TD Bank economist Diana Petramala. Diana, the rate has been left unchanged at 1%. This was as expected by analysts. Is this the best way forward, do you think, in helping to kickstart Canada's somewhat stalled economy?
Well, the leaving interest rates unchanged was widely expected. What was unexpected was a change in language. The Bank of Canada went from saying that the rate increases are less imminent to highlighting that interest rates are going to remain low for some time, which tells us that they're likely going to keep interest rates low at least over the next few years. In terms of the economy, we have seen weaker economic growth over the second half of this year. The Canadian economy basically stalled, and inflation has softened quite significantly. Inflation in Canada is actually weaker than any other G7 economy, including Europe and the U.S., where their economies are struggling a lot more than the Canadian economy. So it's not surprising that we're going to see a lower for longer rate environment going forward.
Now, recently I've had currency strategists tell me they're not that interested in the Canadian dollar at the moment. Why do you think this might be?
Well, the Canadian dollar had gained a lot of support for two reasons. One, the Canadian economy was really outperforming other G7 economies during the recovery, and two, there was the anticipation that interest rates in Canada were going to go up ahead of the U.S. interest rates, as well as other major G7 economies. So that had been priced into the Canadian dollar. So now that the Canadian economy is starting to slow and inflation is weakening, prospects for rate hikes are being pushed out, and that's putting some downward pressure on our loonie.
Taking a look at the wider economy for a moment, exports aren't exactly Canada's strong point right now, and as the US continues to devalue its dollar, will this mean Canadian exports will continue to decline, and how severe would the resulting effect be on the country's economy?
Well, the Canadian dollar had an impact on Canadian exports in 2012. It was averaging slightly above parity. One, two, I think a lot of Canada's weakness in exports over the second half over 2012 largely reflects the fact that Europe was in recession. So we've seen slower growth out of China, and some of the types of goods that the U.S. consumers demand were things that we export less heavily to the U.S. So really, it was a demand story in 2012. Heading into 2013, however, we're expecting U.S. private demand to really pick up, particularly in residential construction, which helps boost Canadian export. So we're actually more positive on the export outlook for 2013 than maybe what we saw in 2012. So we do think that the Canadian recovery in exports, even though they're lagging, is expected to come in the second half of this year.
Canada's resilience during the global financial crisis has been astonishing at times, and the BoC has previously announced it expects 2.3% growth in the first quarter. Do you agree with this prediction?
Yeah, I think the Bank of Canada is a bit optimistic on the first half of 2013. I mean, we still have in the U.S. a significant amount of spending cuts being put in place, and tax increases are likely going to hold down U.S. growth, and therefore, since we're tightly tied to the U.S., Canadian growth in the first half this year. Also, the Canadian economy, we had some tightening in mortgage insurance rules, which constricted how much households can borrow. And we think these are going to continue to weigh on the residential construction and housing market over the first half of this year. Where we really do see growth strengthening, however, is in the second half of this year, where we anticipate a moderate pickup to above-trend economic growth at that time.
Just finally, Diana, is there anything you're concerned about going forward with this most recent rate decision in mind?
I think it's important to note that the Bank of Canada's decision to keep interest rates low and to keep them low for an extended period of time is very, they're basically walking a very tightrope at the moment. So you have on the international front, exports have been weak, not surprising given what's going on internationally. But on the other hand, we do have a lot of imbalances. So we have high household debt, an overbuilt housing market, and an overpriced housing market. I think the conditions for interest rates to remain low going forward is that the Bank of Canada actually sees more what they call constructive performance in imbalances. So household credit is slowing, and residential construction is slowing, and so is activity in the housing market. I think the fact that interest rates are going to remain low is conditional on the fact that these imbalances unwind ahead of interest rate increases. And I think that it's a risk that this may actually not be the case. We could see pickup in activity, particularly with interest rates now expected to remain lower for longer, which may only exaggerate some of the imbalances that are occurring in the Canadian economy.
Okay, that's it for the moment. Keep an eye out for our coverage on some key central bank rate decisions tomorrow, including those from the ECB, the Bank of England and Bank of Japan. But for now, goodbye.